talk about options, and we got to focus for a minute. I know it's been a long day for all of us, and on that note, why don't we give ourselves a hand of applause? We've stuck it out. Can I get something from everybody? Yeah, that kind of helps me. I'm a little tired too, but we're talking options, and this is important stuff. Especially after. A lot of us here, I'm sure, go to a lot of Bitcoin conferences, and we're all pumped up, and we understand the bull case for Bitcoin extremely well. I'm not going to get into that. What I'm going to talk about is, once we have conviction to own this asset, how can we own it responsibly? And in particular, for Treasury management companies, how can we do so under somewhat of a fiduciary responsibility? And it's a unique time right now. There's an incredible amount of demand for Bitcoin, and Treasury management companies and hedge funds are buying this stuff hand over fist. But at some point, we're all going to have to remember that risk management is a huge component of owning a commodity. And so I'm going to show you some stuff on Bitcoin options markets and how you can use options contracts, number one, to acquire Bitcoin, but then number two, to manage downside risk and also generate cash flow, or as I'll say, sats flow. So quick disclaimer, got to do that for options conversations. My company is Blockfills. I'm a partner at the company. Blockfills started in Bitcoin in 2017, and the function that we do is we serve institutional investors and professional market participants. We almost followed the evolution of Bitcoin itself. The company started as a dark pool for spot markets, so players that are coming to buy size Bitcoin and don't want to be tracked on a public order book. You come into a dark pool, and Blockfills fulfills that. And then as the market expanded, we started lending dollars against Bitcoin collateral. That was probably 2019. We started lending US dollars. And then from the lending market, you get a forward curve, so you can price a futures contract. And we started pricing Bitcoin collateralized futures. And then from futures, you get options, and options, you get structured products. This is my book on Bitcoin options, pretty into it, and I got a couple copies. If anyone wants one, come find me. So how do we get here? And what I mean here is the institutionalization of Bitcoin. And so I really think this story starts in December 2017 when the CME launched the futures contract. And that hurdle rate was the Commodity Futures Trading Commission. They had to get past the CFTC for futures. Once that happened, and I was trading on a precious metals desk in Chicago. I was an algorithmic trader and market maker at the CME when Bitcoin futures launched. And I was like, oh my gosh. And I think that started all this. But from December 2017, we had Bitcoin collateralized options markets really started in let's call it 2018. And liquidity really came in 2020. That's when institutional depth entered the market, and Blockfills was there for that. I don't know if anyone remembers, but Paul Tudor Jones and Jim Simmons, they kind of unleashed or gave traditional asset managers some air to breathe in saying that they were behind Bitcoin. Once Paul Tudor Jones came out publicly and said he was investing in Bitcoin, other Wall Street asset managers felt like they could say, hey, we are too, or we're looking at this and we're not crazy. And then, Michael came in 2020, 2021, but that was a little bit less known back then, surprisingly. Really, the big catalyst happened just this year, and that's SOB 121 repeal, which is an accounting mechanism that I'm sure many people here are familiar with. So that summarizes how we got here. Now we have all these publicly traded companies, and we all know that Bitcoin is economic energy, and it's a rocket ship against dollars, euros, sterling, any commodity that is traded in dollars. This is the rocket ship. But you see in the rocket ship, there is a lot of volatility. And we're going to talk about implied volatility, and we're going to talk about these dips. We're going to talk about how to manage risk for these dips, how to buy them, and how to keep conviction when P&Ls are negative. And right now in a bull market, it's easy to really be bullish this stuff, but conviction will get tested again, I'm certain, nearly certain anyway. So that's why we talk about Bitcoin options one sec. We talk about Bitcoin options for treasury risk management, real yield opportunities, upside and downside insurance, which really is what options are, and then my favorite, generating cash flow or sats flow. Here's implied volatility, or just an outline of it. Implied volatility is the anticipated one standard deviation price range of the underlying asset. When implied volatility is elevated, options are more expensive and Bitcoin price ranges are wider. When implied volatility compresses, it's the inverse. Right now, Bitcoin spot reference 107,000. Implied volatility as we speak is right around 41%. And that's a one standard deviation range annualized of 63,000 on the downside and 150,000 on the upside. That's a one standard deviation range for this asset as we speak today. So we all need to be aware of what the market is anticipating for price ranges. This is the implied volatility chart. How far do I go back? That's back to 2021 or end of 2020. And as you can see, volatility is compressing. Michael touched on this. As more institutional participants and professional traders come into this market, they are monetizing vol. They're selling options. They're selling derivatives to create cash flow or sats flow. And that is driving vol down. But vol can become like a springboard. And as we can see here, it's like coiling. And market participants need to be aware of this coil. And if implied volatility begins to accelerate, what are you going to do? You know, what's the strat? How are you planning for elevated implied vol, and what's your risk management strategy? So here's the thesis. Monetize vol. We're still in the adoption phase, super early for Bitcoin, even earlier for Bitcoin vol products like options or structured products. Bitcoin's a very emotional market, so this brings really interesting volatility skew into play, which I'll show you in a sec. And also these IV spikes, they provide really advantageous hedging scenarios. So if you were around in 2021, or if you were around in 2017, you remember what implied volatility did and some of the hedges that you could put on basically at zero cost that were super advantageous. And I'll show you this. This is in my book. I took this picture from my book. This is skew. And if you see 2021, basically what this means is how, like in 2021, the tip of that, where's my pointer? The tip of this, calls got really expensive. No one was even thinking about Bitcoin prices going lower. Everyone wanted to buy Bitcoin. They wanted to buy it on leverage. So what do? You buy futures contracts, perpetual swaps, or you buy out-of-the-money call options. And when significant demand comes in for calls, puts just become super cheap, or the right to sell Bitcoin, which I'll talk about in a sec. So we're kind of entering the potential for this to happen again. If implied volatility coils and spikes, you're going to see skew blow out. And I'll show you some strategies to take advantage of this. And then, of course, the 2022, you see skew gets really, really negative. And that's when there was a tremendous amount of fear in Bitcoin markets. There was contagion risk. Counterparties were blowing up. Everyone wanted protection, or they were just trying to sell Bitcoin. They were like, spot sellers or put buyers. So when you have an asset like this that has tremendous skew, as market operators, treasury management companies, hedge fund managers, Bitcoin mining companies, let's monetize this. Let's plan around what we think can happen for this kind of a volatility asset. So basics on call options. A call option is a contract that gives the holder the right, but not the obligation, to buy the asset Bitcoin at a strike price on an expiration date. When you buy calls, you have the right to own Bitcoin at strike price. When you sell calls, you have an obligation to sell Bitcoin at the strike price. Put options are the inverse. They're a contract that gives the holder the right to sell the asset at the strike price on an expiration date. When you sell a put, not buy a put, when you're the seller, you have an obligation to buy Bitcoin. And I'll talk about how we can use what we call cash secured puts to effectively buy Bitcoin intelligently, I would say. This is the contract specification, industry standard for Bitcoin. Contract, one option is 1 Bitcoin, expiration every day. You can do daily options in Bitcoin. Obviously, monthly and quarterly is the most actively traded contract, and that's at 8 a.m. UTC or 4 a.m. in New York. The strike price is the price at which a trade will execute if in the money, and there's a call or a put is the type of the option. And interestingly, and my favorite part about Bitcoin options is you can take premiums and settlements in Bitcoin, or you can take dollars or euros or sterling, but Bitcoin is what we're here for. So this is the market I'm going to talk about. And when I usually give this presentation, I talk for like 40 minutes, and I give short-dated options, mid-term, long-term options. Today I'm just going to focus on one market, the options market that expires 1 week from today, next Friday, which is obviously the quarterly expiration in a very active contract. So we're looking at June 27, 2025 options, spot reference price, 107,177. I made this presentation on Monday. The forward price is 107,300. That's 10 days to expiration for the option. The vol index, as we covered, is 41% annualized. And that spot forward basis, or the difference in price between the spot market and the futures market, is 4.5% annualized. Actually, let me pause on that one real quick. So when Bitcoin really gets hot, this forward market widens tremendously. That spot forward basis will go from like 4.5% annualized. We've seen it go to 25% annualized. It did in 2021. There wasn't as much sell-side liquidity then, so I don't anticipate that kind of a blowout. But right now, there's just not a lot of demand for leverage, fascinatingly, and in the futures market. So there still is a lot of room for Bitcoin to run here, just based on where the forward curve is and that natural demand for leverage. That's something to always keep an eye on. That's statistical arbitrage, buying spot and selling forward. Here's the first option strat here are the option strats I'll talk about. I will do cash secured puts, which is a yield strategy and a way to accumulate Bitcoin. I'll talk about a zero cost collar, which builds on that. And then for risk management, I'm going to talk about a very simple covered call. And then I'm going to talk about a risk reversal, which builds off of a covered call. And, this was December 2024. Metaplanet, they started getting smart, and they said, wait, we should be selling cash-secured puts. And Dylan certainly has been a force in the market on cash-secured puts. So what is it? What's a cash-secured put? When you come to the market, you want to buy Bitcoin, you have a mandate to buy Bitcoin or whatever reason you want to buy Bitcoin, you can just buy spot. You can always buy spot Bitcoin, right? That's where this thing starts. But there's another way to do it. You sell a put option, and when you sell a put option, you become obligated to buy Bitcoin at the strike price. So if you want to buy Bitcoin, buy spot, or get paid for the obligation to buy Bitcoin. And that's what a cash secured put seller does. So I'm going to show you the June 27th, which is next Friday's options expiration, the 105,000 strike, spot reference 107,000. So when you sell this option, were you to be assigned, meaning were Bitcoin to be at 105,000 or below on next Friday, your effective purchase price based on the premium you earn from selling that option is 102,828 or 876, excuse me. I'll show you on a rudimentary chart here. So what we're looking at is on the left, that's the strike price. You see 92, 95, 97, 100, 102, 105. We're going to sell the 105,000 strike put. That's a 39 delta option, meaning the market is pricing in a 39% chance that Bitcoin trades and settles at 105,000 next week. The bid where you can sell, the willing buyer is willing to pay $2,124 for that option. Think about this as being maybe like a miner who wants to buy insurance so they know for sure they can sell at 105 next Friday, or whatever. Some hedger wants to buy that option. The implied volatility is 39.43% on that option, and someone is willing to sell it at 21.78 when I took this snapshot. So anyway, we're going to sell this option to a willing buyer, and what that's going to do is give us a 72% annualized rate of return on cash. And when you sell this option, you collect $21, $24. Of course, you can take that in Bitcoin, right? Doesn't need to be dollars. I'm just pricing dollars. That's what we're all used to doing in the options world. But when you sell that option, you receive premium on day one. You can take that in Bitcoin, and now you are obligated to buy Bitcoin at $105,000 next Friday. I'm going to build on that. So this next strat is called a zero-cost collar. This is where I'm going to sell that cash-secured put, and when I earn that premium from selling the option, that $2,000+ or Bitcoin equivalent, I can take that premium and go buy call options, which gives me the right to buy Bitcoin. And I'm going to show you a natural skew in the market. So I can sell, let's say I sell 1,000. I want to buy 1,000 Bitcoin. I can sell 1,000 June 27th, 2025, 105,000 puts. I collect $2.1 million. I can then go buy 1,390 call options, 1,390 call options for June 27th at the 110,000 strike. So in this trade, in this structure, I'm obligated to buy 1,000 Bitcoin at 105,000, but I have the right to buy 1,390 Bitcoin at 110,000. And I think you all see where I'm going with this, or if you don't, I'm available for questions after. So let's look at it. This is just the market, again, just to visualize it. Here's the puts. I'm selling the 105s, collecting this. You can see the offers. This is the calls I can buy. I just picked the 110. I'm just showing strats. So the offer for the 110,000 calls is 1528, I think that is. Obviously, you could buy the 115s, 120s. You see the kind of symmetry you can get in exposure-wise. You can also just go one-to-one, buy the 107s or something like that. Yeah, so obligation to buy at 105, right to buy at 110, and you guys get the asymmetry there. So that's the upside. And like I said, I could talk for an hour on the first part of that stuff. I'm not going to do that. But now I'm going to talk about risk management. Those strats were for accumulating Bitcoin, aside from buying spot. So when we talk about Bitcoin, it's very easy to forget about some of these known unknowns or things that we know that we don't know, right? Like simultaneous exchange outages, OTC desk outages, internet, power grid outages. What's that do to Bitcoin? I mean, if North Korea did something in the States and power grids went down for even, 10 hours, 24 hours, what's that do to Bitcoin? We don't know. It's a known unknown. So we should be hedged for some of these situations. There's also the potential for liquidity manipulation. There's some very large holders of Bitcoin that came into this space in 2011, 2012, 2013. These people can be marginal sellers, and they can move markets. We see this regularly. If you watch Bitcoin markets, I'm talking U.S. time, 4 a.m. U.S., markets can move. And so if you get some people who want to come together and kind of skew markets, we can see price manipulation for sure. Bitcoin is not deep enough to defend itself from liquidity manipulation in this current state. And then Michael touched on this and some other people. There's also custody and counterparty risks that can take out prices of Bitcoin where people lose confidence at the margins and become willing sellers. So how do we defend against that? We can sell call options, and this is a very light way to defend, meaning we're going to stay long Bitcoin, but we're going to sell calls, which obligates the holder of Bitcoin to sell Bitcoin at a predetermined strike on an expiration date, and you're going to get paid a yield for selling these call options, and you're basically selling upside insurance into the marketplace. Again, yield is paid on day one in Bitcoin or in dollars. I'm going to show you the 115,000 strike for next Friday, which is 13 delta, meaning the market is pricing about a 13% chance that Bitcoin can trade to 115,000 in a week. And that's going to pay us $546, which is a 20% annualized rate of return. So you own spot Bitcoin, spot reference 107,000. I can obligate myself to sell Bitcoin at 115,000 next Friday, June 27th, and the market will pay me a 20% annualized rate of return for that obligation. I'm showing very short-dated options. You can sell monthly options, quarterly options. Of course, you can go out even further than that. We price 2 years out, I think, is the farthest that we'll price. So selling the 115,000 call, take that premium in cash or Bitcoin. Now you're using Bitcoin to generate sats, right? Like you have this asset, and there's demand for upside optionality, and you can, as the asset holder, you can be a seller of that upside optionality and generate sats. And that's a soft hedge, as I said. This is a real hedge, though. This is where we start to get very interesting. And also keep in mind, vol's low right now. Vol's at 41. If we start to really move and Bitcoin goes 120, 130, 150, these calls are going to get so expensive that you're going to be able to sell them and buy puts, and they're going to be very advantageous positioning for someone who's long Bitcoin. So in this scenario, we're going to sell that covered call, that 115,000 strike covered call option. We're going to take that premium, and we're going to buy insurance, downside insurance, the right to sell the asset. This one, I'm going to sell 1,000 June 27th, 2025, 115,000 strike call options. And look at the asymmetry on this one again. I'm going to buy 1,300 June 27th, 97,000 puts, okay? So this position obligates me to sell at 115, but gives me the right to sell at 97. Even if a bomb goes off, Bitcoin's at 80, I got the right to sell at 97. And here it is on the screen. You see the calls that we're talking about, the 115s, sell it for 546. I can then go look at the put market and see that the 97s are offered for 420. And again, talking dollars, but this can also be Bitcoin. So that's the structure. Sell the calls, obligate yourself to sell the asset that you own, buy protection with the premium in an asymmetric fashion, meaning I'm selling 1,000 calls to buy 1,300 puts. That's all I got for you guys today. I appreciate the time and attention. If you have any questions for me, I'll be outside hanging around.